They didn't make it illegal for you to win. They did something far more effective. They priced you out. While you were sleeping, while markets were quiet and no one was paying attention, they flipped a switch. And that switch has a number on it, $52,000. That is now the cost just to stay in a silver trade, not to buy silver, not to take delivery, just to hold a position and not get wiped out by a margin call. If you don't understand what that means, you are about to become exit liquidity for the biggest banks on Wall Street. This is not exaggeration. This is not clickbait. This is financial warfare, and you are the target. Right now, as this video is being recorded, silver is trading around $115 on your screen. That's the COMEX price, the paper price, the price they want you to believe is real. But here's what they don't want you to focus on. In Shanghai, physical silver is trading near $132 an ounce. In Tokyo, it's closer to $140. In Dubai, around $130. That S of 15 to 25 gap between paper silver and real silver, that is not a market. That is a confession. Raising margins right now is like a casino changing the rules in the middle of a winning hand, except this casino controls pensions, savings, and retirements. And instead of asking permission, they flipped the table. The $52,000 margin hike is not risk management. It is a kill switch. A kill switch designed to protect institutions that are trapped on the wrong side of this trade. Stay with me, because by the end of this video, I am going to show you the exact mechanism the harm effort we're using, why it mirrors 1980 almost perfectly, and the one move this entire system cannot touch. COMEX just announced new margin requirements for silver futures, effective March 2026. Maintenance margin, 51,970 per contract. That's roughly a 35% margin requirement. Here's what that really means. One silver futures contract represents 5,000 ounces of silver. At $115 an ounce, that contract controls roughly $575,000 worth of metal. And now, just to keep that position open, you need nearly $52,000 in cash. 3 weeks ago, that number was about $20,000. Then it jumped to $25,000, then $32,500. Now nearly $52,000. More than doubling in under a month. Ask yourself a simple question. If this market is healthy, if risk is under control, why are they panicking like this? The official answer is volatility. The real answer is exposure. Because the banks are trapped. And there is proof. January 26, 2026, the COMEX delivery report dropped. January is not a primary delivery month. It's supposed to be quiet, boring, low volume. Instead, it just became the 6th largest silver delivery month in COMEX history. Let that sink in. Over 9,500 contracts already stood for delivery with days still remaining. That is millions of ounces of real silver demanded in a month that normally doesn't purport to matter. And look at who's delivering. JP Morgan. Hundreds of contracts in a single day, nearly 1.5 million ounces of silver pushed out the door. Why would a bank famous for suppressing silver suddenly rush to deliver physical metal? Because they're covering shorts. Because March is coming. March is a primary delivery month. And if January, a minor month, is already 6th largest in history, March could break the system. This is the same JP Morgan that paid a $920 million fine for precious metals manipulation. Same playbook, same players, different decade. Just to underline the panic, gold just printed an all-time high above $5,200 per ounce, right after politicians told you the dollar is strong. That's the market calling the bluff. Gold leads, silver follows, and silver is still historically cheap relative to gold. Now let's talk about the physical market, because this is where the illusion starts to crack. People paying $140 in Tokyo aren't stupid. People paying $130 in Shanghai aren't confused. They're informed. They understand something critical. Paper silver is a promise. Physical silver is final settlement. This is what traders call the Great Divorce, the separation between paper price and physical reality. And once that divorce becomes permanent, control is lost. Here's another number you need to hear. In the first 2 weeks of January alone, over 33 million ounces of silver were withdrawn from COMEX vaults. Registered inventory, metal actually available for delivery, has collapsed more than 70% since 2020. At the same time, the paper-to-physical ratio sits near 356 to 1. That means for every single ounce of real silver, there are 356 claims on it. Futures, ETFs, options, derivatives. 355 people own a promise. One person owns the metal. What happens when more than one person asks for delivery? That's called a short squeeze, and the margin hikes are how they try to stop it. Here's how the kill switch works. They suppress price for years by shorting silver they don't have. Price rises, losses grow, they raise margins. Retail traders and smaller funds get forced out. Forced selling knocks price down. Banks cover at lower levels. The system survives. That's the theory. But here's the problem. The physical market is no longer cooperating. Lease rates for silver have exploded toward 8%. That means institutions are desperate enough to pay massive premiums just to borrow metal. The market has flipped into backwardation. Spot prices higher than futures, which screams one thing only: shortage. Immediate shortage. This is what happens right before control is lost. And if you think this can't hit regular traders, look at what just happened in India. In Rajkot, one of the world's largest silver trading hubs, 44 firms went bankrupt in a single week. Over $400 million gone. Not because they were wrong, but because margins moved. That's the danger of playing a game where the house writes the rules. So now we're at a crossroads. Either paper prices rise to meet physical reality, or physical markets abandon paper pricing entirely. Either way, paper loses control. This is why the margin system was quietly changed to percentage-based requirements. As silver rises, margins rise automatically. The higher price goes, the more cash you need just to stay in the trade. That's not risk management. That's financial gatekeeping. And here's the part they can't fix. Physical silver has no margin, no liquidation, no counterparty. It doesn't care what COMEX says. Silver has been in a supply deficit for 5 straight years. Over 1.3 billion ounces consumed more than mined. And unlike gold, silver gets used up. Solar panels, EVs, electronics, medical tech. It disappears. Stockpiles are being drained. China has tightened exports. Demand is accelerating. This isn't fear, it's math. Now let me be clear. Silver can crash. Manipulation can continue. Nothing is guaranteed. But what is guaranteed is this. The $52,000 margin hike is not strength. It's panic. It is what institutions do when the exit door is getting smaller and the crowd is getting larger. History is full of moments like this. Moments when paper promises broke against physical reality. Moments when wealth transferred quietly from those who trusted the system to those who stepped outside it. January 2026 will be remembered. The month silver crossed 115. The month margins hit $52,000. The month the divorce became obvious. You don't have to play their game. You don't have to accept their rules. That's not advice. That's observation. Remember these numbers: 140 in Tokyo, 132 in Shanghai, 130 in Dubai, 115 on your screen. That gap is the truth. Stay awake. Stay informed. And whatever you do, don't let them shake you out.